Hello and welcome to another video session. BeanFX Trader. Our website is www.beanfxtrader.com. Our channel BeanFX Trader, we want you to subscribe to our channel, like our video, make comments below the video, and then ask questions if you are not clear. We'll try as much as possible to respond to your questions. Also hit the notification button below the video so that when we release more videos, you'll be the first to see our video. Today we'll be looking at a strategy that you can use to trade Forex or volatility index. Okay, and this strategy is more like a martingale hedge strategy. This strategy will be good for you if you don't have a very good strategy to make consistent profits and you are consistently in loss and you blow account from one account to another. You blow your account easily. This strategy is good for you. Now, if you are going to use this strategy for volatility index, I'm talking about real account now, your live account volatility index, your minimum balance should be around $300 or above. Should not be lower than $300 for a starting position lot size of 0.001, which is the minimum lot size available on MT5 for volatility index 75. So let me repeat what I've just said. If you are going to use this strategy, this martingale hedge strategy to trade volatility 75 index, your minimum balance, your minimum trading balance, I'm talking about your live account, your real account, your minimum balance should not be less than $300. And then it can be more than $300, can be $500, can be $1,000. And the recommended lot size, starting lot size for this strategy is 0.001 for every $300 or above. So I'm not recommending that you use below $300 because this is going to be a martingale hedge strategy. Okay, it's a very good strategy. It will help you to make profit consistently if you are able to monitor the trades and you are able to follow the rules of the strategy. Now, how it works, the first rule of the strategy is you enter your trades at breakout of support or resistance. You enter your trade. If it's going to be, if we are going long, you buy at the breakout of the resistance. If you are going to go short, you sell at the breakout of the support. But how do you identify support or resistance zones? On my chart, I have volatility 75 index 15 minutes time frame. Now, how you identify support or resistance zones is you can put fractals. You can load fractals once you tap on your screen and you tap on this F button, takes you to indicators. Then you scroll down to fractals. This is fractals. Okay, the third to the last indicator below. as fractals. Okay, and select fractals. Okay, you can see clearly identifies the zones, support or resistance zones. So like on the screen, this 15 minutes time frame, right? So this my, if I'm going to identify my resistance here, this is a resistance area. You can see the fractals. Okay, you can see the fractal around here. So this is my resistance area. This is my support. This is support. Okay, okay, this is a resistance. All right, I see the fractals. So it's like the high point around here. It's like the low point around here. Okay, it's like a, this is a resistance area, and this is a support. Okay, so continues like that. This is support area. You can see the accumulation of fractals, and this is a resistance area. You can see the breakout. You see the breakout around here of this resistance area. Okay, this is another resistance area. Okay, another resistance area. So that's that for identifying your support or resistance area. So if you are going to use this strategy, like for instance this particular point, let me change the color to green. Okay, so this green is a resistance area where we have these breakouts. Let me identify the breakouts. These are breakouts. Okay, let me change the color of the breakout. Okay, let me make it deeper. Okay, you can see as price rose above the resistance, this is my resistance area. You can see two fractals around that point. Okay, and then price broke above it. Can you see? I broke above the resistance area here. So for this strategy, you enter your buy trade around here. So if you are going to enter a buy trade, let me mark that line, that point with a line. So you enter your buy trade on the breakouts. Okay, so let's change the color of the line, horizontal line, to green to signify the buy trade. So these are buy trade at the breakout of the resistance area. So if you are going to sell, you sell at the breakout. Okay, let's look for an example of, okay, like this is a support. This is a support area, but we have a breakout around there. Let me mark it with orange. It is a support. Okay, so price rose up and then dropped and broke that support. Okay, there's a support. You can see the fractal. Okay, price rose up, then broke the support. So if you are going to sell around here, the breakouts. Let me change the color of the line to red to signify my selling point. So I'm going to sell around here in line with this strategy. Sell on the breakout somewhere around here. Okay, so we have been able to identify when to buy or when to sell. So we can buy at the breakout of resistance and we can sell at the breakout of support. Okay, now that's that. Let me remove some of the objects so that we have a clearer or a cleaner. Okay, now we have a cleaner chart now. Okay, chart is tidy. So now let's take an example here. This is my support and I have a breakout of the support. So I'm going to use this strategy. It's a hedge, martingale hedge strategy. So I'm going to use this strategy. So I have a sell, there's my sell here. So my take profit, I can set a take profit. I could decide to take profit at probably 1,000 points below my sell position. Okay, so if my sell position is 403335, okay, so 1,000 points below that for volatility 75 index will be 402335. Okay, let me edit this. 402335. 2335. That will be 1,000 points below the sell position. Okay, so I could take profit at 1,000 points below. I could take profit at 2,000 points below, so that will be 401335. Okay, 401335. So that's 2,000 points below. Okay, and I could take profit at 3,000 points below or 4,000 points below, as whatever my appetite could handle. But the beauty of this strategy is, what if price now goes up against you? You have a breakout, fine. But what if price now start to buy after triggering your sell stop or pending order and starts to sell? Then the sell sold for a bit, picked up your trade, and then suddenly starts to buy. Okay, and you're now in loss. So how do you remedy that? That's where this strategy come in. It's given that you know how to enter your trade, but when your trade now goes in loss, you don't want to be in loss. How do you handle it? So this strategy will help you to handle it so that you break even. What do I mean by break even? Break even is that you are in loss, then suddenly you come back to profit, or you come back to the starting balance. You don't have loss, you are not losing and you are not gaining. But this strategy will not only make you break even, it will also give you some few points, or you make some few scalp profits. Okay, so this strategy is going to be of advantage to you when you have a range, but the disadvantage will now be if the range is overextended. What do I mean by range? When price starts to go up or down and there's no definite trend. So this strategy will help you. But if the price continue to go up and down at a particular point for much more longer period, then this strategy will be of disadvantage. So you like I said earlier, you place your sell trade here. Okay, now price starts to go against you, then you hedge. For this strategy, you hedge with a buy position. Let's change this color of this line to green. Okay, now this is your initial position, so that breakout, but price start to buy. Okay, and you are in loss. So for this strategy, the hedge will be at 4,000 points above your initial entry order. This is your initial or your first order, and it's around here. Let's say your first order is around 4,03200. Let's make it 4,03200. You successfully enter the position at 4,03200. Okay, now you're going to hedge. Immediately you place your sell trade. You don't wait for you to go into loss. Okay, you hedge immediately at 4,000 points. For this example, you are selling, so you hedge with a buy entry order 4,000 points above your sell. This is your sell entry order, so you place a pending order, buy stop above the sell order. This sell trade is running. Now you're going to place a pending order above 4,000 points above it, so that when price goes 4,000 points above your trade entry, it picks the edge trade. Now the edge trade, now let's assume your trade entry for a $300 account is recommended you start with 0.001, which is the minimum, the lowest or the least lot size on MT5. This is your 0.001 sell trade. Then your hedge, which is your buy trade, will be times 3. You multiply it by 3. Okay, this particular pending order will be multiplied by 3. So that means you now, this your buy stop order will now be 0.003. Okay, so and it's going to be 4,000 points. Now 4,000 points above 4,03200 will be 4,07200. Just add 4,000 to 403,200. That will be 407,200. So just edit this to 407,200. So this 4,000 points above. So this is going to be your hedge trade. It's going to be 0.003. This is your initial running. This is your running trade, sell trade. You sold due to the breakout of this support zone. That's the reason why you sold. Okay, but you have, and this is like a hedge, like an insurance in case price goes up, picks this. Okay, so that means once price is going down and start to go up, this your initial 0.001 trade will be a loss. Okay, and once it gets there, it picks another trade, making your second trade, which is your edge trade, your first edge trade. But this time around is 0.003. Okay, so you now have 2 trades running. Remember, your account balance is going to be $300. Starting account balance for the least or the lowest lot size, which is 0.001, going to be $300. And for the sake of this strategy, it's advisable you test it on demo account first. Don't go live. Test on demo account to understand how it works before you go live. So you have 2 running trades. The first trade, which is your sell trade, and the second trade, which is your buy trade. Okay, so the initial sell trade, okay, if price starts to go down, like we have in this example, price obviously went down and you sold and you are a big profit. Wow, that's good. If you are in profit and it does not come up to meet your edge trade, fine and good, enjoy your profit. But if it comes up to meet your edge trade here and it triggers this edge trade and you start to have, and you immediately have 2 trades running, then you set take profits for both trades and you place the second hedge trade. Let me take it again. if you place your first trade and you are in profit, no need to panic. Enjoy your profits. But in case price goes against you and come up to pick your edge trade, then you have to take profit for this trade, which is your first trade. Please take profit for this trade, which is your second trade. And also place edge trade in case price is in its range, in case price starts to range. Okay, so that means you place, if price comes down again, it triggers, is already selling, then it goes up and trigger your edge trade. Then you have to place another insurance, unlike an insurance, in case price comes down. Let's change the color to orange this time around. So this will be at your initial first trade point. But this time around, you have, for this one, you have 0.001. For this trade, your hedge trade, you have 0.003. Then this trade will be 0.008. Reason being that you have your edge trade is 0.003. Multiplied by 3, that's 0.009. Your initial trade is 0.001 plus 0.008, that's 0.009. So that will cushion the effect of this edge trade. So it's like multiplying the edge trade with 3. So you have 3 here, then you have 9 here. Okay, don't forget you have 2 trades here. The first trade, which is your 0.001, plus your second hedge trade, which is 0.008. Okay, so that's that. In case price goes up again, you have the final hedge trade. Your final edge trade, let's color that light green. Okay, so this will be your final edge trade. You place it here. All right, exactly the same point where you have your first edge trade. And what will be the lot size this time around? You already have 9 here, 0.009 here, multiplied by 3, that's 0.027. Okay, and your initial edge trade here, you have 0.03, 0.003. Now you want to have a total of 0.027 here. Now 0.027 minus 0.003, that's 0.024. So this, your third and final edge trade, will be 0.024. So once you add 0.024 plus 0.003, you have 0.027, and that balances the 0.009 you have here. Don't forget this 0.001 and the orange is 0.008. So don't forget the first trade, which is my sell trade, this is my sell trade, okay, is 0.001. The second trade, which is my first edge trade, this green one, is 0.003. Now the third trade, which is this orange trade, which is the second edge trade, is 0.008, and the final one is 0.024. Okay, now how do we set take profit and stop loss? Remember, the distance between the initial entry and the hedge pending order is 4,000 points. For volatility 75 index, you have 4,000 points. So your take profit will be 2,500 points. So that means your take profit for your okay, let me change the color to black. Color of take profit, let me change it to black. Okay, so that means your take profit will be 2,500 points from down here, from this point. Okay, down here you have 2,500 points. Just a minute. Okay, okay. So you have 2,500 points. Measure 2,000. Now when you have 0.440, let me change the, just a minute. When you have 40, the initial entry order, 403200, okay, as our initial entry order. So if you remove 2,500 points from that, you now have 40, 4007, 407, 400, should be 400700. You have a way of calculating it. So your 2,500 points below the initial entry order will be 400700. Okay, no, it's too wide. Is it? No, it is not. It's okay. So that's your take profit. And you repeat the same thing for the hedge trade above. This hedge trade above, repeat same 2,500. So what this implies is that if I have the starting trade, okay, this red line is my starting trade. This is my starting trade. I sold here because of breakouts. So if I have this starting trade, I allow trade to run if it does not go up to hit my edge trade here. But if it hits my edge trade, I have to immediately set take profits for my edge trade. Okay, 2,500 points above my edge trade. Okay, then I set take profit for my initial trade, and then quickly add the second hedge trade. Let me take it again. Okay, this is my first trade. I sold because of breakout. Okay, but price now start to go up and it triggers my hedge trade here. All right, now I set take profit for my hedge trade. This to take profit for my hedge trade, 2,500 points. Don't forget the distance between this sell and this first hedge trade is 4,000 points. So I set another 2,500 points for my hedge trade. Then I set 2,500 points for my initial trade, and I had another hedge trade in case price comes down. Now, as I had another hedge trade, of course, I will have edited the take profit for that other hedge trade to be constant 2,500 points. Now, if price comes down to trigger this second hedge trade, which is the orange hedge trade, then I immediately add the third and final hedge trade. Okay, and also edit the take profit for the third and final hedge trade to be 2,500 points. Okay, so but I've set my entries and price start to range and picks my hedge trade up and down. Okay, what about stop loss? Now the stop loss will now be, I'm going to draw another line this time around. Let me change the color to purple. Okay, now the stop loss will be 200 points below the 2,500, meaning if I have my initial entry, which is this red line, and I have the first edge trade, which is this green line. This is my first edge trade. Okay, and I set my take profit for my first edge trade. All right, this is my take profit for my first edge trade, and this is my take profit for my initial sell entry. And I place stop loss 200 points for this hedge rate. The stop loss will be 4,000 plus 2,005 plus 200. That will be that will be 6,700 points. Okay, let me take it again. My initial sell entry order here, my first hedge trade here. The take profit of my first hedge trade is 2,500 points, and its stop loss will automatically be 6,700 points. Okay, which is 4,000 plus 2,500 plus 200. That will be the stop loss. All right. Same thing. My initial entry order, I'm going to set the take profit to be 2,500, and the stop loss will be. Let me get a purple line for stop loss. Will be 6,700, which is 4,000 up to the first edge trade point, then 2,500, which is the take profit of the first edge trade point, then plus 200 above that 2,500. Okay, so I'm going to repeat the same thing for the second edge trade. This is my second edge trade in case price comes down, to have take profit of 2,500. Okay, and stop loss of 4,000 plus 25 plus 200, which is 6,700. Then I'll repeat the same thing for my third and final edge trade. Okay, and the take profit of the final edge trade will also be 2,500. Then stop loss will be 4,000 plus 2,500 plus 200. So that way I'll break even, and I also make some profits. Okay, so don't forget the steps. First of all, mark support or resistance. Like we have a resistance around here. Okay, we have a resistance around here, and we have a breakout, so I buy. But if price goes against me, I hedge. All right, so that's that. So same thing, I sell. Price goes against me, I hedge. So that's that. So now let's look at if we can have a practical example. Let me wipe out all the objects. Okay, we have a clean chart, and we have a live price ticking up and down as usual. So if I'm going to buy, I will buy around here if there's a breakout. Okay, if I'm going to sell, I'll sell around here if there's a breakout. If there's a breakout lower. Okay, so that's the way the strategy works. Okay, but if I see that I'm in a range, I could sell around here, and I could buy around here. But whatever decision I make and whatever trade I make, I provide my insurance, or I place my hedge. Okay, now let's practice. Okay, now let's assume I place a buy trade. I'm going to buy 0.0014 for 300. The account balance is a demo account, 9999. So let's start with 300. Let's start with 0.001. So I buy. Okay, I place a buy trade. It's my buy button. The order has been placed. Now I have a buy position. I buy a buy trade. Okay, and I immediately set my edge trade 4,000 points below the current buy trade. Now what's the buy trade? I have 392,543. So 4,000 points below. Okay, will be 3,8. It's gonna be okay. It will be 388543. Okay, so it will now be multiplied by 3. So I'm going to have a sell stop. Use my sell stop. Okay, 388. Just a minute. Let me get the price again. If the price is 392543, so the sell stop will now be 4,000 points below 388543. So let me place my sell stop. 3 multiplied by 3. Okay, I have 388543. 388543. Okay, so I place my sell stop. All right, so I have an insurance in line with this strategy. This is my running trade, and this is the insurance. Okay, like a hedge. The lot size for my running trade is 0.001. The lot size for the hedge trade is 0.003. Okay, this strategy is something you sit with. If you don't have time to sit or babysit your trade, don't use this strategy. Use this strategy when you only have time to babysit the trade and see it through the third and final edge trade if price is going to range up to that. Okay, now I've placed my entry. Let's look at it on the 1 hour time frame. Probably we'll see. Okay, what about 4 hour? Okay, what about daily? Okay, it's below, far below. You can see the sell stop at the bottom. Okay, let me put a line so that we can see it. Okay, so that's it here, there. So that's the sell stop there. That's my insurance. Okay, if you can still see it there, let me put it on a weekly. Let's see if you can see it. Okay, that's it. All right, so I'm buying, but I've placed a sell stop. Let me go back to 15 minutes time frame. Now my take profit for buy could be 1,000 points, so I could set it at 1,000 or 2,000 points. If I'm going to set my take profit for my buy trade to be 2,000 points, so I will now have 394543. Press on the trade, press on modify. 394543. Okay, so that's my take profit. That's 2,000 points. Okay, so you can see this is my take profit, 2,000 points. All right, this 2,000 points, that's my take profit for the buy trade. All right, but if price now goes down, okay, I'm expecting price to go 3,000. Just a minute. Expect price to come up here and hit my take profit. But if it now goes down and triggers my sell stop, this is my sell stop at 388543, then I'll set the take profit to be 2,500 points. Now take profit of at 38, this is the sell stop order. So take profit of 2,500 points at 388543 will be, I'm going to deduct 2,500 from this. We now have 386043. So the take profit will be 3860. You have to do some calculation with this strategy. 386043. So that means we deducted 2,500 points from 388543. Okay, so we automatically, since this has been triggered, we only do this when the sell stop is triggered. But if the sell stop is not triggered and price gets to our take profits, or even goes higher and we start to trail our profit, well, we are good. But if price does not go to the take profit and starts to go against our trade, that means we made the wrong trade, or we placed the trade at the wrong time, then we focus on the insurance. Once the insurance trade, which is our pending order, is triggered. These are pending order. Once it is triggered, once this pending order is triggered, then we quickly adjust the take profit for it and adjust trade profit for the initial trade. Then we also make stop loss for it and stop loss for the initial trade. Then we place our edge trade. Now remember, the first trade is 0.001. This first edge trade is 0.003. Remember, we said our edge trade, the second edge trade will now be a buy trade, buy stop, and to be 0.008, and the point will be exactly at the same point with our first trade. What do I mean by that? So had it been price did not eat our take profit, but rather came down and triggered our first edge trade, then we have two trades running. Two trades will be running. Then we clearly need another insurance. Okay, and the other insurance will place another trade, a buy stop. You know, we have a buy trade running, then we now have a sell stop, and it is triggered. So we have buy and sell. Then we have to place a buy stop as the second insurance. So the buy stop, the point will be at 392,543.48. So I'll have 0.008. So I'll place my buy stop 392,543.48. Buy stop 0.008. Buy stop 392,543.48 to be a buy stop this time around. Okay, although I can't place this buy stop because price is almost at our price is dancing around that point, so I can't place buy stop at that point. But it being price has gone down to trigger this sell trade, this particular sell trade, then I'll be able to conveniently place the buy stop at this point. But since price is still at this point, it's going to be difficult for me to place a pending order on that point. I hope you understand what I mean. Now, if we now have the buy, if we now have the three trades now triggered, then we'll place the final fourth trade, which is our third edge trade, and that will be placed at this point, 388,543. Okay, don't forget the take profit for all the trades will be 2,500 points, and the stop loss will be 6,700 points. So you must make sure you stop the edge at the third edge trade. That means you have total of four trades triggered. If they are all going to be triggered, make sure you stop and take your loss. Of course, the loss will be quite heavy, but it is rare. It is rare. You understand what I mean? It is rare, but you can backtest and see for yourself. Make sure you follow the rules. Place your trade when you have a breakout of resistance or support. It could be on 15 minutes time frame, it could be on 30 minutes time frame, it could be on 1 hour time frame. So when you have a breakout of support or resistance, take your trade. And hedge, you have a first edge. If the first edge is triggered, place the second hedge. If the second edge is triggered, place the third hedge. So by so doing, you break even and you also be in a profit, small profit. Then you can wait for the next opportunity where you place your trade. So let me make a recap. Ensure you allow price to break out of resistance. Like these are resistance, this is another resistance, this is support. Now we have a support here. Now this is another support, this is support. So and this is a resistance. Okay, so make sure price breaks out of resistance or support before you take your trade. Right now price is in the middle of more like a short fall. So once price breaks higher above this resistance here, okay, you can take your buy trade. Or once price goes lower below this support here, you can take your sell trade. Or if it is at this point price breaks lower, you can take your sell trade. Or if at this point price break higher, you can take your buy trade. Or if at this point price break higher, you can take your buy trade. So that's the way the strategy works. Make sure you have a breakout before you enter your sell or your buy trade, as the case may be. Now, place the entry. If it's going to be a buy, place your buy entry. Then place the insurance, which is your first edge trade. Multiply it by 3. Okay. If the edge trade, if you now start to be, you have a breakout, then you now start to have record loss. Price, it was a fake, it ended up as a fake breakout, which is a fake out, and you now start to have loss. And it went as far as 4,000 points below your buy trade, start to record loss. Then it will trigger your edge trade, which is 4,000 points below. Once the 4,000 points edge trade is triggered, set take profit 2,500. Set stop loss 6,700. Then also set take profit for your initial entry 2,500. Set the stop loss for 6,700, and immediately place the second edge trade and watch and monitor your trade. This kind of strategy, you have to babysit your trade until everything closes. Then you relax and wait for another breakout before you enter your trade and start the cycle all over again. So there are instances where you roll with the breakout and you make some profit. There are instances where the breakout will turn out to be a fake out, and it will come, price will come down or go up to hit your edge trade, and then you start to babysit and monitor the trades. So that's that for this strategy. Don't forget, ensure you have a breakout before you enter your trade. Ensure you place your edge trade immediately. Now, if price continue in the range and goes again to back to your initial entry order, place another edge trade. If price again goes down and hits the other entry, the edge trade, place the third edge trade. Always multiply. Make sure that you have 1 against 3. Always multiply by 3. If your account balance is 300, you start with 0.001. The first edge trade will be 0.003. Second edge trade will be 0.008. The third edge trade will be 0.024. So if your account balance is 600, you can start with 0.002 as your initial entry order, the lot size of your initial entry order. If price goes against you, the edge trade will be multiplied by 3, that's 0.006. And if price goes against you again, multiply by 3. So you continue to multiply by 3. Make sure both sides is ratio 1:3 for the trades and the edge trades. Then if your account balance is $900, start with 0.003. Of course, the first edge trade will be 0.009. So the reason why we are having minimum balance as $300 is to ensure that you have enough room to weather the storm up to the third edge position. Okay, this is a proven strategy. I've backtested it and I've even tried it on live accounts, and it works. Okay, ensure you have it. Once you have a breakout and you enter your trade, if it turns to be a fake out, you are good. Okay, except for rare occasion where you now have multiple, like to the 4th edge trade, to the 5th edge trade, and that is very rare. If only you enter on breakout. Ensure you use 15 minutes time frame or 30 minutes time frame or 1 hour time frame. Those 3 time frames are good for this strategy. Don't go below 15 and don't go above 1 hour. Okay, for your time frames. Okay, I believe I've touched every necessary area you may need to ask questions or as regards this strategy. But if you have more questions, you can state it below the video. We'll try as much as possible to respond to your question. Ensure you try this strategy on demo accounts first so that you understand it. And if you are not going to have time to babysit when your first edge trade is triggered, if you don't have time to babysit the trade, don't even start. But if you have enough time to babysit and wait for your trade to play out on volatility 75 index, then you can enter your first trade. Don't forget minimum balance for real account. If you are going to use real account, minimum balance is $300. So that's that for this strategy. Like our video, subscribe to our channel BeanFX Trader, make comments at the bottom of the video. If you like the strategies, just tell us you like it. If you don't understand any part of it, state it below the video. We'll try and clarify. Also, hit the notification button, the bell button at the bottom of the video, so that when we release more strategies that can help you to trade Forex or volatility index, you'll be the first to see it on your notification bar. Okay? Then you can go to our website, www.beanfxtrader.com. We have so many strategies that we have published on the website for you. So till I come your way next time, is bye for now.